Welcome back to the channel. Let me tell you about two people. Same age, same city, same starting salary, same everything. Person A gets their paycheck every 2 weeks, pays their bills, buys what they want, enjoys their life, and puts whatever is left, which is usually not much, into a savings account earning almost nothing. Person B gets the exact same paycheck every 2 weeks, pays the same bills, but then does something completely different with the rest of it. They put their money to work. 20 years later, person A is still working, still living paycheck to paycheck, still one unexpected expense away from financial stress, still wondering why, despite decades of hard work, they never seem to get ahead. Person B has options, real options. The option to retire early if they want to. The option to walk away from a job they hate. The option to travel. The option to give generously. The option to live life completely on their own terms. Same income, same starting point, completely different financial destination. What made the difference? Person B understood something that school never taught and most people never figure out until it is too late. Money is not just something you earn and spend. Money is a tool. And like any tool, in the hands of someone who knows how to use it, it can build something extraordinary. In the hands of someone who does not, it just sits there, or worse, disappears. Today I'm going to teach you exactly how to use money to make more money. Not theory, not vague advice, not motivational fluff. The actual mechanisms, the actual strategies, the actual vehicles that turn dollars into more dollars, compounding quietly and powerfully in the background of your life, whether you're sleeping, working, traveling, or spending time with the people you love. This is one of the most important things you will ever watch. So let's make sure every minute of the next 20 counts. Let's go. Today we are covering the complete framework for making your money work for you. We are going through 8 powerful money-making mechanisms, from the most accessible starting points to the more advanced strategies, in a logical sequence that builds on itself. Whether you have $100 to start with or $100,000, there is something in this video that you can implement this week. Let's build your money machine. Why most people never make money with money before we get into the strategies. We need to understand why most people never crack this code. Because it is not for lack of desire. Everyone wants their money to grow. The reason most people never make it happen comes down to 3 fundamental misunderstandings. Misunderstanding number 1. They think investing is for wealthy people. This is the most pervasive and most damaging financial myth in America, the UK, and Canada. The truth is that the wealth gap between the rich and everyone else exists largely because wealthy people invest and most other people do not. Investing is not what you do after you become wealthy. It is how you become wealthy. Misunderstanding number 2. They think they need to time the market. They wait for the perfect moment to invest. They wait for the market to drop. They wait until after the election. They wait until interest rates change. They wait until they feel more confident. And while they wait, the people who simply invested consistently and ignored the noise are compounding their way to financial freedom. Misunderstanding number 3. They think risk means loss. Every time someone says they are afraid to invest because they might lose money, what they are really saying is they do not understand risk. Because the greatest financial risk of all is not investing, which means guaranteed erosion of purchasing power through inflation every single year you hold idle cash. Understanding these 3 misunderstandings and genuinely releasing them is the prerequisite for everything that follows. Because the strategies I am about to share only work if you are willing to actually implement them. Mechanism number 1. The force that Albert Einstein reportedly called the 8th wonder of the world. Compound interest. Let me explain compound interest in the most human, tangible way possible. Because most people have heard the term, but very few people genuinely feel its power in their bones the way they need to. Simple interest means you earn interest on your original amount only. You put $10,000 in an account earning 10% per year. You earn $1,000 per year. Every year. Forever. Compound interest means you earn interest on your original amount and on all the interest you have already earned. That same $10,000 at 10% per year compounding annually, earns $1,000 in year 1. But in year 2, you are earning 10% on $11,000, not just the original $10,000. So you earn $1,100. In year 3, you earn 10% on $12,100, and so on. The numbers start slowly. The early years feel almost underwhelming. But then something extraordinary happens around year 10, 15, 20. The growth starts to curve upward so dramatically that the numbers become almost unbelievable. Let me give you the concrete numbers that will make this real. $10,000 invested at 10% annual return. After 10 years, $25,937. After 20 years, $67,275. After 30 years, $174,494. After 40 years, $452,592. You invested $10,000 once. You never added another dollar. And 40 years later, it became $452,000. That is not magic. That is mathematics. That is compound interest working across time. Now here is where it gets truly extraordinary. What if instead of investing $10,000 once, you invested $500 every single month consistently for 40 years at a 10% annual return? The total you would have contributed $240,000. Your own actual money put in over 40 years. The total value of your portfolio, over $3,100,000. $3,100,000 from $500 per month. The extra $2,860,000 came from compound interest. From money, making money, making money, making money, over and over and over again across decades. This is the foundation of everything. The earlier you start, the more time you give compound interest to work, the more extraordinary the result. Every single year, you wait costs you far more than you realize. The best time to start was yesterday. The second best time is after this video ends. Mechanism number 2. The simplest and safest starting point for making money with money. If you have money sitting in a regular bank savings account right now, you're almost certainly earning somewhere between 0.01% and 0.5% annual interest. On $10,000, that is $1 to $50 per year. That is genuinely insulting, and it is completely unnecessary. High-yield savings accounts at online banks in America are currently paying 4.5% to 5.5% annual interest. In the UK, cash ISAs and easy access savings accounts are offering 4% to 5.5%. In Canada, high-interest savings accounts are paying 4% to 5% or more. On that same $10,000 at 5% interest, you earn $500 per year. In a regular account, you earn $50. The high-yield account pays you 10 times more for the exact same money with the exact same risk, because these accounts are government insured up to $250,000 in the US, £85,000 in the UK through the FSCS, and $100,000 per depositor in Canada through CDC. Now I want to be clear about what high-yield savings is and what it is not. It is a completely safe, liquid, accessible place to park your emergency fund and short-term savings while they earn meaningful interest. It is not a wealth-building vehicle. At 5%, you are barely outpacing inflation in most years. But for the money that needs to be safe and accessible, your emergency fund, your down payment savings, your tax savings, a high-yield savings account is dramatically better than letting that money sit earning nothing in a regular account. Move your emergency fund. Move your short-term savings. Move any cash that you do not plan to invest for at least 12 to 24 months. Do it this week. That single action on $20,000 in idle savings generates $1,000 in additional annual income with zero additional risk. That is found money, and it is just the beginning. Mechanism number 3. The wealth-building engine that has quietly created more millionaires than almost any other investment vehicle in history. Index funds and ETFs, exchange-traded funds, are collections of stocks that track a broad market index. The most famous is the S&P 500, which tracks the 500 largest companies in America. When you buy an S&P 500 index fund, you own a tiny piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 496 other companies, all in a single investment. Here is what makes index fund investing so extraordinarily powerful for ordinary people. First, diversification is automatic. You are not betting on any single company. You are betting on the entire American economy, or the entire global economy if you choose a global index fund. One company failing does not meaningfully affect you. The overall market recovering, as it has done after every single crash in history, is what matters. Second, the costs are almost nothing. The best index funds charge expense ratios of 0.03% to 0.1% per year. That means on a $10,000 investment, you pay $3 to $10 per year in fees. Compare this to actively managed mutual funds that charge 1% to 2% per year, which on a $100,000 portfolio costs you $1,000 to $2,000 annually and consistently fail to outperform the index funds they're competing against. Third, the historical returns are extraordinary and consistent. The S&P 500 has returned an average of approximately 10% per year since its inception, including every recession, every crash, every war, every pandemic, every financial crisis. That 10% average is through all of it. Fourth, you need almost nothing to start. Many platforms allow you to buy fractional shares of index funds for as little as $1 in the US, £1 in the UK, and $1 Canadian in Canada. Let me show you the real-world application of this. An American investing $400 per month into a broad S&P 500 index fund starting at age 25 and continuing until age 65 at a 10% average annual return would accumulate approximately $2,548,000. The total amount they personally contributed, $192,000. The rest, over $2.3 million, is the market doing the work for them. A UK investor putting £300 per month into a global index fund through a stocks and shares ISA, completely sheltered from capital gains tax, achieves similar extraordinary results with the added bonus of tax-free growth. A Canadian investor maximizing their TFSA contributions into a broad index ETF builds wealth that is never taxed on withdrawal, one of the most powerful wealth-building advantages available anywhere. In the developed world, index fund investing is not exciting. It will never make you rich overnight, but done consistently over decades, it is one of the most reliably wealth-generating activities available to ordinary human beings. Start. Automate. Forget about short-term noise. Let time do the work. Mechanism number 4. Getting paid simply for owning pieces of great businesses. Dividend investing is one of the oldest and most satisfying forms of making money with money. You buy shares in companies that distribute a portion of their profits to shareholders, called dividends, on a regular schedule, usually quarterly, sometimes monthly, and the money just arrives in your account without you selling anything, without you doing anything, simply because you own the shares. The most compelling dividend investments are what investors call dividend aristocrats. Companies that have not just paid dividends consistently, but have increased their dividend payments every single year for at least 25 consecutive years. These companies have raised their dividends through the dot-com crash, through the 2008 financial crisis, through COVID, through every economic storm of the modern era. Think about what that means. These are businesses so financially strong, so consistently profitable, so competitively entrenched in their markets, that they have been able to give their shareholders more money every single year regardless of what the economy was doing. Now let me give you the compounding magic of dividend reinvestment, called DRIP, Dividend Reinvestment Plan. Instead of taking your dividend payments as cash, you automatically reinvest them to buy more shares. Those new shares generate more dividends. Those dividends buy more shares. The cycle compounds on itself. An investor who put $20,000 into a diversified dividend portfolio with a 4% yield and reinvested all dividends, assuming 7% total annual return, would have approximately $152,000 after 30 years. An investor who put the same $20,000 in a savings account earning 1% would have $26,997 after 30 years. Same starting amount, same 30 years. Dividend investing with reinvestment produced $152,000. The savings account produced $26,997. The difference is almost $125,000 from a single initial investment with no additional contributions. This is what dividend investing with reinvestment does across time. And it becomes even more powerful when you add to your positions regularly, buying more shares and generating ever larger dividend payments that buy still more shares. The income stream that results after decades of discipline building is one of the most financially liberating things a person can create. Money flowing into your account every single quarter simply because you own pieces of great businesses. Mechanism number 5. The asset class that has created more millionaires throughout human history than any other. Real estate is unique among all investment vehicles because it offers multiple simultaneous returns. And understanding all of them is what makes real estate so extraordinarily powerful as a wealth-building mechanism. Return number 1. Rental income. Your tenants pay you every month. After mortgage, taxes, insurance, and maintenance, the net cash flow is money in your pocket simply for owning the property. Even modest cash flow of $300 to $500 per month per property adds up significantly and grows over time as rents increase while your fixed-rate mortgage payment stays the same. Return number 2. Mortgage paydown. Every mortgage payment your tenant makes on your behalf reduces your loan balance and increases your equity. You're being paid to build equity in an asset you own using someone else's money. Return number 3. Appreciation. Real estate in most developed markets appreciates in value over time. The average annual appreciation across the U.S. has been approximately 4% to 6% historically. In the U.K., long-term average appreciation has been similar. In major Canadian cities, appreciation rates have been even higher. As the property value rises, your net worth rises with it. Return number 4. Tax advantages. In the U.S., real estate investors can deduct mortgage interest, property taxes, insurance, maintenance, and depreciation against their rental income. The depreciation deduction in particular is an extraordinary paper deduction that reduces your taxable income without costing you a single dollar out of pocket. In the UK and Canada, similar tax structures make real estate ownership highly tax efficient. Return number 5. Leverage. This is the multiplier that makes real estate unlike any other investment. You put 20% down on a property and control 100% of the asset. When that property appreciates by 5%, you have not earned 5% on your investment. You have earned 5% on the full value of the property, which on a 20% down payment represents a 25% return on your actual invested capital. Now let me address the reality of real estate investing honestly. It requires more capital to start than stock market investing. It requires management, either your own time or the cost of a property manager. It is less liquid than stocks, and it carries risks, vacancies, problem tenants, unexpected repairs. But for investors willing to do the work and willing to think long-term, the combination of cash flow, equity buildup, appreciation, tax benefits, and leverage makes real estate one of the most complete wealth-building mechanisms ever created. And for those not ready to purchase physical property, REITs give you real estate returns in a stock-like format, creating an income engine that earns without your direct hourly involvement. There is an important distinction that most people never grasp, and it is the distinction that separates people who trade time for money, which is all of us starting out, from people whose money and systems earn on their behalf. Active income requires your direct time and presence. You work 1 hour. You earn 1 hour's pay. You stop working. The income stops. This is how most people earn their entire lives, and it has a fundamental ceiling. There are only 24 hours in a day. Scalable income can grow beyond the limit of your personal time. You build something once, a system, a product, a platform, a service business with employees, and it continues generating revenue whether you are actively involved or not. Let me give you the most accessible examples of scalable income streams that ordinary people are building right now in America, the UK, and Canada. Digital products. You create an online course, an ebook, a template, a software tool once. The creation process might take days, weeks, or months. But once it exists, it can be sold to thousands or hundreds of thousands of people without any additional creation on your part. Platforms like Teachable, Gumroad, and Udemy handle the delivery automatically. Every sale that happens while you sleep is your money working for you. Content platforms. YouTube channels, blogs, and podcasts, like the one you're watching right now, are content assets. Each piece of content you create continues generating views, traffic, and revenue for years after you created it. A YouTube video uploaded 3 years ago is still earning advertising revenue today. That is a scalable income asset. Affiliate marketing. You create content, a blog post, a YouTube video, a social media post that recommends products and services through tracked links. Every time someone purchases through your link, you earn a commission. Automatically, without any additional work on your part. Your content keeps working. The commissions keep arriving. Service businesses that hire. The freelancer who only sells their own time has an income ceiling. The freelancer who builds an agency, hiring other skilled people to deliver services, has now created a business that scales beyond their personal hours. The agency earns. The team delivers. The business owner builds equity in something larger than themselves. Licensing and royalties. If you have created something, music, photography, written content, a patented invention, proprietary software, licensing the creation to others generates royalties. Ongoing income from something created once. The common thread in all of these is this. You invest significant upfront time, energy, and sometimes capital. In return, you create an asset that continues generating income beyond your direct involvement. That is the transition from trading time for money to having money and systems work for you. It is not overnight. It is not easy, but it is available to far more people than ever before in human history, thanks to the internet. And it is one of the most powerful pathways to genuine financial freedom. Mechanism number 7. The legal wealth multiplier that governments in America, the UK, and Canada have created specifically to encourage people to invest, and that millions of eligible people are not fully using. This might be the single most overlooked mechanism in this entire video. Because the difference between investing inside a tax-advantaged account versus outside one is enormous over decades. Let me explain exactly what is available in each country. In the United States, the 401k allows you to invest up to $23,000 per year in 2026, pre-tax, meaning every dollar you contribute reduces your taxable income dollar for dollar. If your employer offers matching contributions, that is free money. Free, an immediate 50% to 100% return on your contribution before the investment even has a chance to grow. Not taking full advantage of employer matching is one of the most expensive financial mistakes an American worker can make. The Roth IRA allows you to invest up to $7,000 per year in after-tax dollars, and all growth and withdrawals in retirement are completely tax-free. On an investment that grows from $7,000 to $70,000 over 30 years, you pay zero tax on the $63,000 in growth. Zero. In the United Kingdom, the Stocks and Shares ISA allows you to invest up to £20,000 per year completely sheltered from income tax and capital gains tax. All dividends earned inside an ISA are tax-free. All capital gains are tax-free. On a large ISA portfolio generating £10,000 per year in dividends and capital gains, the tax saving at a 20% tax rate is £2,000 per year. Every year, for the rest of your life. In Canada, the TFSA, tax-free savings account, allows Canadians to invest and withdraw completely tax-free. Contributions do not reduce your taxable income like an RRSP, but all growth and all withdrawals are forever tax-free. The RRSP, Registered Retirement Savings Plan, allows contributions that reduce your taxable income now and shelters growth from taxation until withdrawal and retirement. The mathematical impact of tax-advantaged investing versus taxable investing over long periods is staggering. An investor in a 30% tax bracket investing $10,000 per year in a taxable account, paying tax on dividends and capital gains annually. Over 30 years at 8% return accumulates approximately $900,000. The same investor putting the same $10,000 per year into tax-advantaged accounts, sheltering all growth from taxation, accumulates approximately $1,200,000 over the same period. The tax-advantaged investor ends up with $300,000 more, not from investing more money, but from keeping more of their returns through legal tax sheltering. Max out your tax-advantage accounts first, before any taxable investing, every single year. This is not optional advice. It is foundational. Now we bring everything together. Because the real wealth-building magic does not happen from any single mechanism in isolation. It happens when you stack multiple mechanisms and let them compound simultaneously. Here is the complete framework, in the exact order you should build it. Stage 1, the foundation. Open a high-yield savings account and move all idle cash there immediately. Build your emergency fund to 3 to 6 months of living expenses inside it. This stage gives you safety, liquidity, and meaningful interest on money that used to earn nothing. Stage 2, tax-advantaged investing. Maximize your employer 401k match first. It is the highest guaranteed return available to you. Then contribute to a Roth IRA in the US, match your ISA in the UK, or maximize TFSA and RRSP contributions in Canada. Put broad index funds, specifically a total market or S&P 500 fund, inside these accounts. Automate the contributions on payday. Never touch them. Stage 3, additional taxable investing. Once you are maximizing tax-advantaged accounts, open a taxable brokerage account and continue investing in index funds and dividend stocks. The tax efficiency of index funds makes them suitable for taxable accounts as well. Stage 4, real estate. When you have built sufficient capital and financial stability, consider adding real estate to your portfolio. A single rental property generating positive cash flow while appreciating in value adds a powerful additional dimension to your wealth building. Stage 5, scalable income. Simultaneously, begin building at least one scalable income stream. A side business, a content platform, a digital product, something that has the potential to generate income beyond your direct hourly involvement. Funnel all income from this stream directly into your Stage 2 and 3 investments. Stage 6, protect and optimize. Ensure you have adequate insurance. Work with a tax professional to optimize your tax position. Review and rebalance your investment portfolio annually. And as your wealth grows, consider working with a fee-only fiduciary financial advisor who is legally required to act in your best interest. This is not a plan you execute overnight. It is a framework you build methodically, one stage at a time, over months and years. But here is what I want you to genuinely feel in your bones right now. Every single mechanism in this framework is available to you today, regardless of your current income, regardless of your current financial situation. The framework scales from $50 per month to $50,000 per month. The principles are identical. The mechanisms are identical. The only variable is the amount of money flowing through the system and the amount of time the system has been running. Start where you are. Use what you have. Build from there. Before we close, I need to address the mindset dimension of everything we have covered today, because the mechanisms I have shared are widely available. The information is not secret, and yet most people never implement it. The reason is almost never a lack of knowledge. It is almost always a lack of the right mindset. Making money with money requires patience. The most powerful returns are almost always invisible for years before they become impossible to ignore. The investor who started at 25 and did not feel the compounding magic until they were 40. Those 15 years of patient, boring, consistent investing are what made the magic possible. It requires the ability to think long-term in a world designed to make you think short-term. Every advertisement you see is designed to make you spend now. Every social media post of someone's new purchase is a subtle invitation to spend now. The entire consumer economy is built to redirect your money away from wealth building and into consumption. Resisting this, consistently and deliberately, is the foundational act of financial self-determination. It requires trust. Trust that the mechanisms work even when they're not producing visible results. Trust that the market will recover after it drops. Trust that the rental property will find a good tenant. Trust that the business will eventually generate income. Trust is what keeps you invested when everything feels uncertain. And staying invested is what produces the extraordinary long-term results. And it requires starting before you feel ready. Because no one ever feels ready. There's never a perfect time. There is never a moment when all the conditions are ideal and the uncertainty has cleared and the path forward is perfectly obvious. The people who successfully use money to make more money are not the ones who waited until everything was perfect. They're the ones who started imperfectly and kept going anyway. If this video gave you real value, please hit the like button right now and share it with someone who needs to hear this. Subscribe for weekly financial education designed to genuinely change how you think about and use money. Drop a comment below. Tell me which mechanism you're implementing first. I read every single comment, and I genuinely want to know where you're starting. Go put your money to work. I will see you in the next video.